Assalamu alaikum. In this session, we'll talk about the double entry system of bookkeeping. We have studied last session the accounting equation. Now I will remind you of the accounting equation. If you look at the accounting equation, it was assets equals liabilities plus owner's equity. We will have example consists of 9 transactions to show us how the statement of financial position will change with transaction when the business starts. Number 1, Mr. Adam, who is the entrepreneur or the owner of the business, he opened bank account for ABC company and deposited $3,000. So the first transaction is depositing the capital of the new business. We have A became 3,000, that's cash. L is 0, there is no liability. OE became 3,000, so we increased assets and increased owner's equity. You look at the financial position, we have assets, cash in bank 3,000 and capital 3,000 equal. Transaction number 2. Mr. Adam decided to borrow $2,000 for ABC company from the bank. If you remember, we were talking about assets. This is going to be a non-current liability. Financial position, assets, cash in bank, 5,000. Because 2,000 plus the 3,000 that we have already in the capital became 5,000 cash in the bank. Liabilities, bank loans, 2,000. Is another item. And the third item is capital, 3,000. 5,000 equal 2,000 plus 3,000. Third transaction is purchase of equipment in cash, $2,000. Cash will be reduced by 2,000, so I will have cash in bank 3,000 and the equipment is 2,000. Total is 5,000. Continued financial position, we have 2,000 bank loan and 3,000 capital. There's no change because the change happened when we reduced cash and added equipment. Fourth transaction, ABC purchased delivery van on credit from XYZ company. ABC will pay to XYZ 24 installments on monthly basis. Each monthly installment is 250, which means that we have 6,000 as an additional asset. That's 24 months multiplied by 250. Let's look at the financial position. Now we have new asset. It's delivery van, $6,000, and we have the equipment, $2,000 we purchased previously, and the cash in bank not touched, 3,000. Total is 11,000. Now the equation is growing, the financial position is growing. We have assets of 11,000. We started with 3,000 deposited by the owner, and then we added 2,000 equipment, and we have 6,000. Liabilities, we have 6,000 new liability, that's for XYZ, and we have the bank loan, so our total liabilities became 8,000 and our capital $3,000. Fifth transaction, ABC purchased inventory of 4,000 on credit from EFG. So look to the financial position. What change has happened? Delivery van as it is, equipment as it is, inventory, new item, $4,000. Cash in bank as it is, 3,000. So total assets again increased by the 4,000 that we added for inventory. It became 15,000. Let's look to the liabilities. You have the trade payable, that's the inventory, the credit of the inventory, 4,000, XYZ as it is $6,000, bank loan 2,000. So the increase of 4,000 is increasing our liability to become 12,000 while our capital is as it is. Let's go and see transaction 6. ABC sold goods of $600 in cash. So from the inventory that we bought, we sold $600 in cash. Delivery van stay as it is. Equipment stay as it is. Inventory is reduced by the 600 that we have sold. Cash is increased by the 600, so the change happened here in these two lines. So it's reduced and this was increased. It's movement between assets. Nothing happened for liabilities or capital. Seventh transaction, sale of inventory of $1,000 on credit. So again, inventory is reduced, and we'll see what happened in the financial position for the other side. Delivery van is as it is, equipment as it is, inventory is reduced by another 1,000, so it became 2,400, and new asset line item is shown. Trade receivable, $1,000. Cash in bank as it is. Total is still 15,000. No change in liabilities or capital. Number 8, ABC paid the first installment to XYZ for the delivery van. Remember we said that we have 24 monthly installments. The first installment is paid of $250. So the cash will be reduced. You see, delivery van is as it is, equipment as it is, inventory as it is, trade receivable as it is. Cash is reduced by 250. So the remaining is 3,350. Now our asset has reduced by the 250 that we paid. Trade payable is still as 4,000. XYZ credit has reduced by the 250 that we paid from cash, and bank loan is still as it is, and the capital is still as it is. Total is 14,700. Last transaction is number 9. We collect the trade receivables. Remember, we have trade receivables that was 1,000, now it's 0, while cash has increased by 4,000. While all others, as delivery, van, equipment, inventory, are as they are. No change in liabilities or capital. And I just want to remind you, or maybe it's the first time I mentioned it, maybe you have noticed it. When you look to the assets, when we listed according to their permanence. So the longer term asset comes first. If you have building, it will be first, then we have the van, then we have the equipment, you have the inventory, you have trade receivables, then you have the cash. The next session will be on the same thing. We'll talk about double entry system. Thank you.